This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Rocky month. The Dow closes this historic February with a nearly 400-point drop, snapping its longest win streak since 1959.
Taking a stand, a prominent national gun seller will immediately stop selling assault-style weapons, and the CEO is calling on elected officials to do more on gun reform.
Filling up. Prices are on the rise and expected to go even higher, and that could throw the economy a curveball. Those stories and more tonight on Nightly Business Report for Wednesday, February 28th.
Good evening, everyone, and welcome. Well, February is in the books, and what a month it was. The Dow fell 1,000 points, not once, but twice. The fear of inflation and the prospect of rising interest rates spread quickly through the markets. But as quickly as stocks fell, they rose again. The major indexes recouping a large part of those losses. If anything, the month marked the return of volatility, something that hasn't been seen in quite some time. The Dow Jones Industrial Average was off 380 points to 25,029, led lower by a drop in energy stocks and also oil prices. The Nasdaq was down 57 and the S&P 500 fell 30. For the month, all of the major indexes suffered losses. Bob Pisani takes a look at the month that was and what March may bring.
February has proven to be nothing short of tumultuous for the markets. Even though stocks have recovered roughly 70% of their losses since the correction, the Dow is still down 4% for the month. It's the first February loss in 9 years. Beyond that, both the Dow and the S&P also snapped 10-month winning streaks. This is an amazing run. We haven't seen a 10-month stretch of gains since 1959. So will March be a mess too? Not necessarily. Data show that in February, where the S&P drops more than 2%, the S&P was positive in March 67% of the time, an average gain of 2%. It's not bad. Still, March brings no shortage of other market-moving events for investors to focus on. First up, the Fed. Federal Reserve Chairman Jay Powell returns to the hot seat tomorrow when he testifies before the Senate. We'll see if he walks back any of his previous comments about the economy strengthening that spooked equity investors on Tuesday. Right now, the markets are pricing in about a 90% chance of a March rate hike. But it's looking more likely there will be 4 hikes this year instead of 3, and that's got people concerned. But there's plenty of other data for the Fed to factor into the equation. The jobs report is next Friday. It means another update on wage growth, along with a handful of other inflation reports and a first look at first quarter GDP. Finally, lawmakers in Washington will have their hands full dealing with another debt ceiling deadline. Government funding is set to expire in the first half of the new month. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
All right, here to talk about where the markets stand and where she sees stocks heading next is Christina Hooper, Chief Global Market Strategist at Invesco. Christina. It was a rough month. What's next?
Welcome to a new era, Tyler. This is the beginning of what is likely to be market conditions that will continue for most of this year, if not longer. We're seeing monetary policy normalize, and as monetary policy normalizes, so will markets. And this is actually more normal than what we've seen in the past decade.
You know, Christina, it seems to me that the market's uncertainty also is focused on the new Fed chief. He is not like Fed Chief Yellen was in terms of his attitude towards the market. And I didn't get a sense in his testimony the other day of exactly what his position on monetary policy is.
Well, let's put it this way. I don't think he's the monetary policy ideology twin of Janet Yellen. And we actually got some insight into that in January when the transcripts from the 2012 FOMC meetings were released. And what it showed was Janet Yellen being very, very supportive of QE3, while Jerome Powell was much more concerned about the bloating of the Fed's balance sheet and really reluctantly agreed to embark on QE3. So what we see is some very significant differences already, but markets didn't necessarily expect that. And that's why I think it's no surprise that we saw all this volatility this month just as the baton was being passed from Janet Yellen to Jerome Powell.
When you used the word earlier, the normalization of monetary policy, I take that for meaning as code or economists speak for rising interest rates as the economy regains its footing and its health. But that doesn't mean that you can't continue to make money in stocks, does it?
No, absolutely not. And in fact, let me qualify by saying normalization in this case isn't just about rate hikes.
Right.
It's about taking down the balance sheet. And that actually was the great experiment we've been in for the past decade. But having said all that, while we are going to expect to see more volatility, volatility creates opportunity. So we would expect to see an upward bias to stocks this year, but with a lot more volatility attached.
Are there areas of the market that you think still hold value? I mean, we have come down, obviously, from the lofty levels that we hit at the end of last year, but do you still find ample opportunity here at home, or are you looking overseas for your clients?
Both. So at home, technology looks very attractive, and we should be pleasantly surprised with earnings growth this year as well as revenue growth. But we also want to look outside the United States because there are an awful lot of opportunities in emerging market stocks as well as developed stocks, particularly in Europe, where monetary policy is far behind where we are in the United States. And of course, within the U.S., I can't say enough good things about dividends. Many companies are increasing their dividends as part of how they are spending the windfall they've gotten from the tax cut.
All right, Christina, great to see you.
Great to see you.
Christina Hooper with Invesco.
Meantime, in economic news, economic growth was revised lower for the fourth quarter. Gross domestic product, which is the broadest measure of goods and services produced across the U.S., rose 2.5%. The lower reading came as companies drew more from their inventories than previously estimated, meaning they had to produce less. This report, along with other recent data points, led some economists to lower their forecasts for first quarter growth.
Pending home sales fell to a 3-year low, primarily because of a lack of supply, which the National Association of Realtors says is at crisis levels. The report sent shares of some popular home builder ETFs much lower today, and it comes on the cusp of the important spring selling season. Here's Diana Olick.
Whether it was a newly built home or an existing home, buyers purchased fewer of them in January, a clear sign that while demand is still high, more and more people are unable to find a home they can afford. Sales of existing homes fell sharply in January. An index measuring signed contracts, meaning buyers out shopping and making deals during the month, dropped close to 5% compared to December and about 4% compared to a year ago. Realtors blame a critical supply shortage, especially on the cheaper end of the market where so much of the demand is. There is plenty of supply in the new home market, but builders today are focused on the move-up and luxury sectors, not on the entry level. New homes in general come at a price premium, and that may be why those sales fell in January as well. January was when mortgage rates began to rise, and while they are still historically on the low side, they have been even lower for so long that any increase is a shock to the system.
You add the mortgage payments going higher on top of the fact that home prices continue to escalate at an unusually high rate, and affordability does become an issue, at least psychologically, if not fundamentally, for a lot of buyers.
Home prices are rising far faster than wage growth and inflation, and the biggest price gains, again, are on the lower end of the market, where demand is strongest.
More new listings will come on the spring market, but they're unlikely to come close to meeting demand. Adding to the issue, homeowners are actually staying in their homes longer than ever before, an average 10 years. They either can't afford to move or are afraid they won't be able to find anything to move to. For Nightly Business Report, I'm Diana Olick in Washington.
One of the nation's largest sporting goods retailers is immediately ending the sale of all assault-style rifles. The announcement by Dick's is one of the strongest stances yet by corporate America in the national discussion over guns. Shares of the retailer rose in today's trading session, and the decision by Dick's is being attributed to the decline today in the shares of the gun makers. Sturm Ruger slid to a near 3-year low, Vista Outdoor fell 4%, and American Outdoor Brands is near a 5-year low. Brian Sullivan has more.
Silence equals violence.
The backlash against assault-style weapons took another big business turn today as national sporting goods chain Dick's Sporting Goods said that it will immediately stop selling AR-15 style guns as well as high-capacity bullet magazines. CEO Ed Stack is the son of the founder of the company and head of the Pittsburgh-based chain. He went on NBC Nightly News to explain that he is not anti-gun, But the emotional reaction around the nation to the Parkland, Florida shooting spurred this decision.
When we looked at those kids and we saw the grief that they were going through, the parents were going through, and how these kids organized to really have their voices heard, we talked amongst ourselves and said, if these kids can be brave enough to do this, then we should be brave enough to make a stand ourselves.
This is not the first time the chain has reacted to a mass shooting. After the Sandy Hook, Connecticut killings in 2012, Dick's suspended sales of assault-style weapons. However, a few months later, it resumed sales of those guns through its Field and Stream subsidiary. This time, though, the CEO said the change is permanent. And he didn't make it just about the industry either. Stack also called on Congress to take action.
This is a complex issue, and we hope that Congress on both sides will sit down with the intent of finding a solution.
Dick's will continue to sell other types of guns, but is raising the age to buy them to 21. And this move leaves fewer national retailers selling assault-style weapons. Walmart stopped selling AR-style guns 3 years ago. So now attention will likely turn to the other major retailers still stocking their shelves with AR-style weapons, including stores such as Bass Pro Shops, its Cabela's unit, and Camping World's Gander Outdoors. CNBC did reach out to those retailers for comment, but is yet to hear back. For Nightly Business Report, I'm Brian Sullivan.
Time to take a look at some of today's upgrades and downgrades. The Dow component Verizon saw its rating raised to buy from neutral at MoffettNathanson. That firm says that the rewards of tax reform outweigh the risks of a challenging environment. The analyst also cites a wireless market that's shaping up to be better than previously expected. But shares did fall fractionally along with the broader market. They closed at $47.74. Fellow Dow component Chevron saw its rating raised to buy from neutral at Bank of America Merrill Lynch. The analyst says the company is in a better position than its international peers, and that could lead to share buybacks. Price target still at 138. Stock fell today to 111.92.
Comcast's rating was cut to neutral at Macquarie one day after that company made a $31 billion bid for Sky. The analyst says that while adding Sky would diversify Comcast's portfolio, it would also expose the company to a satellite sector under pressure. The price target is $42. Shares of Comcast fell 1% to $36.21. Comcast is the parent company of CNBC, which produces this program. The drug developer Tesaro saw its price target cut by at least 9 firms. Many cited disappointing quarterly results and sales of a key cancer treatment. A number of firms also expect Tesaro to face increasing competition. The stock fell 10% to $55.23.
Still ahead, why Lowe's just can't seem to catch up to rival Home Depot. Lowe's quarterly results fell well short of analysts' expectations. Profit margins squeezed there. Company's number 2 home improvement chain has been spending a lot of money trying to convert shopper visits into sales. But that bet did not pay off, widening the gap between what it and industry leader Home Depot have been able to put up. Shares of Lowe's fell 6% in trading today. Courtney Reagan digs deeper into Lowe's quarter.
A strong housing market sets up home improvement retailers well, but then it's up to the retailer to execute. That's where Lowe's stumbled in the most recent quarter. Results were mixed, not as strong as rival Home Depot's. Sales to professionals grew at a faster rate than sales to do-it-yourselfers at Lowe's. Sales to pros is where rival Home Depot dominates. But Lowe's gross margin, a measure of profitability, fell compared to last year. On the earnings call, executive pointed out shortcomings in customer service and sales staff in Lowe's stores, particularly during big weekends and events. The home improvement retailer is entering the year with a new plan to improve its business, which includes getting a better understanding of its shoppers, processing orders more quickly, and boosting its supply chain. It also has to make sure the right inventory is in stock, so when shoppers come in, they buy. While Lowe's management is taking an active role in the strategy to turn around execution missteps, it may be from the influence of activist investor D.E. Shaw, which took a stake in the retailer late last year.
It seems as though the activist investors are already having some type of impact on the company. This may reflect Lowe's taking a much more aggressive tack towards investment and sort of say repositioning its company. Activist intervention with Lowe's is long overdue. They're doing the same thing as Home Depot. They're just doing it not nearly as well. And so if we can get someone in here to help the company run better, that'll be a positive.
Well, the holiday quarter just closed. For home improvement retailers, the real holiday quarter is the spring, which is just around the corner. Investors will be looking for any green shoots to see if Lowe's new strategy is leading to growth. For Nightly Business Report, I'm Courtney Reagan.
Sales take off at TJX companies, and that's where we begin tonight's market focus. The off-price retailer said more shoppers came into its stores during the holiday period, and that helped revenue beat expectations. The company expects to increase its sales and foot traffic in the year ahead. TJX also raised its quarterly dividend to 39 cents a share and said it would repurchase up to $3 billion worth of its shares this year. As a result, the stock rose nearly 7% to $82.68. The women's clothing company Chico's reported profits and revenue that beat street estimates. The owner of the brand White House Black Market did see same-store sales decline, but it was an improvement from the prior quarter, and it was better than what analysts were expecting. The shares climbed 15% to $10.04. Fewer customers made purchases at Office Depot, causing the office supply company to report a quarterly loss and weaker sales. The company, which issued disappointing guidance for the year, said it is working to grow profits, and that 2018 will be its transition year. The shares fell 9% on the day to $2.63. And the footwear maker Crocs reported a wider than expected loss and is calling for revenue to be flat this year. The company is in the process of reducing its store count. And that's not what investors wanted to hear, so they sent the shares down 13% to $12.24.
The FDA has turned down Celgene's application for its experimental multiple sclerosis drug, saying it needs more information on the treatment to even consider approving it. The drug is considered a key one in Celgene's pipeline, and this latest announcement creates an unclear timeline of when the medication will be available to patients, and that caused shares to plummet 9% to $87.12. Bill Ackman's activist hedge fund Pershing Square Capital reportedly building a stake in the defense contractor United Technologies. The stake first reported by CNBC. UT recently said it was exploring a potential breakup of its business lines. Shares of United Technologies up a fraction to $134.74. Mr. Ackman has also reportedly exited his long position in Herbalife 5 years after he made a $1 billion bet against the supplement company he called a fraud. He shorted the company. Ackman, according to CNBC, expected shares of Herbalife to drop to zero, but instead, shares rose, now up more than 60% over the past year. Shares of Herbalife up 6% today to $92.10. And after the bell, Salesforce reported earnings and sales that edged past expectations. The cloud computing company also gave stronger than expected guidance for the year and hiked its forecast for fiscal 2019. Shares volatile in the extended session, but they ended the regular day down 22 cents at 116.25.
Oil prices fell today, but they are up 14% over a one-year period, and they're expected to keep climbing. And since gas prices closely follow oil prices, that could cause some pain at the pump. So how high will they go, and what does that mean for households and the economy? Here to talk about that is Patrick DeHaan. He's the senior petroleum analyst at Gas Buddy. Welcome back, Patrick. Nice to have you here.
Thanks for having me.
Why are prices moving higher at the pump? Is it seasonal? I mean, I know we see it when we get into the spring, but is there more to it than that?
Yeah, there really is. Unfortunately, this isn't just as simple as baseball season coming. A lot of this has to do with seasonal maintenance that starts to take place at refineries across the country. And as we progress towards warmer weather, we're also transitioning to more expensive summer gasoline, which adds to the cost. So those two pressures, combined with oil prices that you mentioned are much higher than where they were last year, are kind of creating this foundation for gas prices that will likely be at their highest seasonal levels since 2014. In some places, certainly could get close to that key $3 a gallon threshold.
But I thought production was higher, Patrick. Is this the fact that demand is higher too?
Exactly. So many people have been hearing about U.S. oil production, which, yes, is at its highest level since 1970. But the takeaway is that while oil production here in the United States is very high, about 10 million barrels per day, you'll remember back to 2017 when OPEC enacted production cuts, which have more than offset any rise in U.S. oil production. So we're at a net loss here. And over the last year and a half of those production cuts from OPEC, U.S. oil inventories have been draining at a fairly expeditious rate, and that has set the ground for higher oil prices moving forward.
So what do you think, net, the economic impact might be? Obviously, it's going to cost consumers more to fill up at the pump, and certain states like California tend to have very high gas prices anyway. So what do you think the economic impact might be?
It's going to sting. Gas prices could go up another 25 to 35 cents a gallon by Memorial Day. And of course, if you talk about the possible likelihood of an increase in federal gas tax, that could add another 25 cents. You're talking about a massive increase in price. And every penny that gas prices go up, it generally takes $1 to $2 billion out of other areas of the economy. So you really could see a slowdown in economic growth if gas prices continue to go up.
And it takes more, if you get those kinds of price increases, it takes more than $1 or $2 a week out of the pockets of American consumers. Are you banking on the possibility, on the likelihood of a gas tax increase? I mean, it has been floated as an idea, but the GOP Congress is not particularly friendly toward any kind of tax increase.
Yeah, this is certainly not the time. Not that there is a great time for any tax increase, but with gas prices now already without this tax being among the highest they've been in several years, to pass a gas tax increase that's so significant, especially if it were to happen all at once, really could be political suicide, especially when it could push the national average above that key $3 a gallon threshold.
Patrick, we'll leave it there. Thanks so much. Appreciate it.
My pleasure.
Patrick DeHaan with Gas Buddy. Coming up, thieves have a new target. It's your gift card.
Washington has become the first state to pass rules governing the internet. The bill reinstates protections recently repealed by the Federal Communications Commission. The measure forbids broadband companies from blocking or slowing lawful internet traffic or selling so-called fast lanes at a premium. Lawmakers in more than 25 states have introduced similar legislation.
Spotify has filed to go public. The world's largest music streaming service plans to list on the New York Stock Exchange under the symbol SPOT. The filing shows that the company has more than 70 million paying customers and nearly 160 million monthly active listeners. That's as of the end of last year, but it's also burning through some cash.
Well, I bet you use gift cards. They're easy to use, particularly when you're in a pinch. They're convenient, growing in popularity. Americans spend nearly, get this, $30 billion a year on them, and according to the National Retail Federation, that number is growing. But the cards are also a prime target for hackers, looking to cash in on all that spending. And criminals have figured out how to use gift card balances before you or your gift card recipient get the chance. Andrea Day has more.
Last year, $1 billion was stolen out of gift cards. There's definitely going to be an increase in the risk this year.
A worrisome trend for Omri Aluz, CEO at the cybersecurity company Perimeter X, where they've been watching criminals drain millions from gift cards in seconds flat.
You never scratch the numbers. It's brand new, and the balance is already out.
And he says they don't need to steal numbers from those gift cards you see in store racks or the card in your wallet.
What we are seeing them do today is take an online gift card and manufacture a physical gift card from thin air.
Here's how it works. He says hackers unleash an army of bots, or a botnet. They can attack the retailer's website or mobile app, where you register your gift card and check the balance, and start guessing numbers.
These attacks are completely automatic, and they operate very quickly. We've seen attacks as large as doing 10 million guesses an hour. The moment you are able to guess a gift card number extracting the value out of it is very easy.
And he says criminals simply add the balance to fake cards and put them up for sale on the dark web before your real gift card is even unwrapped.
This is what makes this attack so much more dangerous. As a consumer, there is not a lot you can do to actually stop these attackers.
So what can you do?
Always make sure to know how much money is on your gift cards. Most stores would give you your money back if you tell them that the balance disappeared. When you check the balance, always do it only on the real, authentic merchant website.
But he says even that won't keep your money safe. According to Aluz, it's up to retailers to stop virtual thieves.
We urge merchants to use more complex text line for the gift card, combine numbers and digits, include a PIN number.
According to the National Retail Federation, some security measures are already in place.
Some of the retailers are actually eliminating the opportunity for individuals to go online and even check their own balance. And instead, they're putting in 800 toll-free numbers for people to call.
And Aluz says there are solutions out there retailers can use to have almost complete protection, not just for websites, but for mobile apps too, which are critical to safeguard. For Nightly Business Report, I'm Andrea Day.
Volatile day and a volatile month to close out. The Dow was down 380 points. The Nasdaq was off 57 and the S&P 500 was down 30. For the month, all of the major indexes suffered losses. That does it for us tonight. I'm Sue Herrera. Thanks for joining us.
Thanks for me as well. I'm Tyler Mathisen. Have a great evening, everybody. March 1st is tomorrow.
Yes.
February's behind us. We'll see you then.